Excellent. Well, it's great to be here. It's great to be in person. Big day, big conference, and Equity Release Awards dinner later. We're getting off Plan B, and above all, most importantly, it's Tish's birthday, and that's fantastic. So if you've got the cake, make sure it's in the house. And let's get into the subject area of what we're talking about here today. And I thought it'd be good I'll try and whiz through this as quick as possible, though I've got the precedent of Stuart Wilson for a very long, short, early presentation. But nevertheless, I'll try and do this. So let's get the context right in terms of the history of, as we look into this whole realm of policy and regulation. I mean, looking at this sort of 30-year history of the Council, obviously we're celebrating the 30 years now. And our market, I would say, has been a good example of good policy and regulation working well for our market and consumers, whilst recognising the need to consider the risks of the contrary, the risks of bad policy and bad regulation, and also recognising and realising that there's a long way for us all to go as a sector to get it absolutely right. The first equity release product goes way back into the days of the 60s before we even won the World Cup in 65, and you'll see as it's developed, the trajectory of the market has been very much hand in hand with the standards, which indeed, you could call it our policy as a council, predate the regulation of lifetime mortgages from some 13 years and indeed home reversions by 16 years. And our standards have remained a core part of the industry's growth and development and relationship with the regulatory landscape, whether that's in the form of the FCA, which no doubt we're particularly going to look into, but also the PRA as well. And so what the purpose, indeed the policy of our standards has been the same throughout this 30-year history, to provide confidence to all those in the market, including, of course, consumers, about the safe release of equity. However, this architecture around the standards has changed, it's evolved, so that it's not just in name only, but that we seek to properly demonstrate and provide that demonstrable value that comes from supporting good consumer standards. That journey evolution is ongoing, and so this year you'll see fairly shortly also the next iteration of significant evolution to ensure that our standards that we share together reflect modern equity release. So let's just briefly touch on the pandemic. I know we're coming out of Plan B, but we can't shake it off, obviously. And so particularly, those were the expectations of some experts, and I won't name them, that had this particular expectation for the market. And what perhaps could have even been worse is if this particular proposed dip would have been even more so if we hadn't got ourselves as a whole industry together through the council to ensure that we're able to ensure the option of remote independent legal advice to keep the market going, alongside obviously remote valuations and the like. And that was really a very important time for the council to help support the industry to keep its lights on. Obviously, in this period of time, we've seen increased scrutiny from the FCA with its report into the sector and also with those CEO letters. An area obviously particularly looked at by the FCA was the importance, and I think I heard Stuart talking about records, otherwise known as also evidence, trying to properly evidence personalised advice, and that's something that we were very much working on beforehand, and we're able to provide that expanded checklist which goes hand in hand with guidance, support and encourage best practice. And what I really welcomed is there's been great collaboration across our sector to seek to address, and it's an ongoing issue, to seek to continue to address those concerns highlighted by the FCA and ensure also that the FCA is up to speed with modern equity release. Issues around transparency have been particularly looked at and will continue to be looked at to understand properly, to ensure that we make it as easy as possible for consumers to work out and understand different fee structures, charges, and to help them be able to look at difference between what products are being offered and advice propositions. On due diligence also, so important to ensure that lender and advisor communities are focusing particularly, not least on issues and concerns around lead generation. And advisor development, there's already been talk about that and how we work together very much. Indeed, the FCA focus was around the treatment of young borrowers. And we're obviously wanting to really bang the drum for the great flexibilities that have increased in relation to use of products and features, and also to ensure that circumstances are properly tailored in later life and can be accommodated. And the issue of communication, which we all want to be about, to be as transparent as possible throughout the life cycle of a product and those that receive equity release at all those different stages and events in life. And so what was the reality? Well, the reality, thankfully, wasn't what the experts said it was going to be. And so we're in a place where you'll know, obviously not least through the market report that's been released, that we're in a position where we're in a clear direction of growth to the 4.8 billion lending level. And that's, I think, has come from the industry, along with the wider financial services, showing the resilience that has stood the test of even the pandemic, along obviously with external factors, the property value increase, the stamp duty relief support, but also those internal significant building blocks and the product optionality that is around. And so just briefly then, just in the review, there's a whole lot of activity now going on. You'll see the stats there. And we're recognising, as you all are, that we need to ensure that we carry on this direction of travel, that as lockdown is thankfully being eased, that's had a big factor impact. There's also obviously the continued regulatory focus that we're going to look at further, particularly broadening now in terms of the proposed consumer duty, which obviously affects the whole of financial services. Alongside that, which is particularly significant, has been our council's membership, which has increased in these challenging times some 13%. We've been refreshing the brand, and without being too self-promotional, I think it shows that whether you like them or not, the money-saving expert, we've got money and pension service and also step change, just to reflect how they're endorsing very much the council, which I'd say is very much them recognising the value of us as a council and our standards and as a standard-setting trade body alongside regulation. So if you're not a member, if not, why not see me after? But anyway, moving to the aspects of what we're all about. And it is about product innovation. It's been wonderful to see more than 700 products out there now today, up from 58 in 2016. But also what remains is those socioeconomic factors, the issues of intergenerational fairness, the inadequate pension savings, and an ageing population. And of course, I will keep banging on about it, the council's standards, which are key pillars to provide support in the structured financial advice process, which is obviously mandatory to ensure, though, there's support in checklisting and guidance, the independent legal advice side of things, and also clear product standards. So we've looked at that over the 2019-20 to ensure that it isn't just in stone, but it's a living document, and it reflects properly the need to move to a place where we're looking very much at a principle-based, outcomes-focused approach. And so what do our members say? And it's, as far as myself as the chair of the council, we need to be in line with the members, and that's what they say they want us to be doing to provide customers with that trust in our products. And so what's the future challenges? Well, the future challenges are going to look at this operational for us all, the issue of supply, of having sufficient advisors on the ground, and certainly we've seen, not least in the legal side of the market, there's been a real challenge, and you'll reflect that in some of the delays that you're experiencing, not just on a customer-facing side, but also lender side as well. And we're working on that to help support and encourage that, and I'll pick up on that in a moment. But we have defied expectations in relation to the pandemic. No doubt there's a lot more that needs to be done. But one of the issues that still is prevailing, isn't it, is the socioeconomic pressures of an elderly population and paying for their costs. But also there's the regulatory challenge, and that continues, and it will continue, and it particularly now embraces the consumer duty. And there are, at a high level, I think many of us would say that there's a welcome approach in terms of the broad approach, but it's a high level. We want to know the details, don't we, of really what it will mean, and ensure that, for example, the concerns about being retrospective, going into the back book. Now, myself as a former legislator, that's something that would be particularly shunned, going retrospectively into matters. And it's also a matter for regulation to exercise with great care and caution to be going into the back book. But we can talk about that further in our panel. But certainly welcome the challenge from the FCA, and we would say that we're on that trajectory in relation to the standards with their consumer-focused, their outcomes-based and focused on principles. And the other issues, though, and I think something that we've all got to look at further, is the issue of sustainability and the green issue. And we know we've got the oldest housing stock in Europe, and there's still a long way to go to be able to deal with it, the sustainable property market that we want, and to ensure the sector is properly able to lend appropriately with eco-homes. So, just to conclude, opportunities come along with challenges, don't they? And those challenges, as I mentioned, in relation to sustainable homes, we would like to see, obviously, that progress and more real green products coming out, and us more helping people as they want to meet that challenge. Innovation, we're looking to help innovate, and there'll be more news around our standards, trying to ensure they are properly in line with modern equity release. But also, and I mentioned the lawyers, I'm a lawyer myself, so I will mention them again, but we're trying to help increase the supply, not least of lawyers, to ensure there's more modern equity release literate lawyers around. So the competency framework, which was widely welcomed in terms of financial advisor development, we're moving into the train of supporting a legal competency framework. Many are talking much more, members are saying how there's been an uptake in inquiries in relation to gifting, and bridging that gap, that intergenerational gap that there is, particularly in property wealth, where there's huge opportunities. And finally, there's the attitudinal shift, isn't there, to try and ensure that more people recognise and understand modern equity release, that there is a consumer education piece out there, with many still reluctant to embrace the opportunities, or at least to be informed properly about what is involved. And if you haven't done yet, I'd welcome you looking at our Home Advantage report, which was an important survey of 5,000 people to particularly look at how what they found almost half people, their generation's attitude to debt in later life has become more accepting than their parents. So there's an opportunity there. And just to finish off then, that I think it's probably you've heard enough from me, haven't you? You can say, Rob? Let's get on with the debate and discussion. Thank you.
Thank you very much, David. And we'll kick off with the panel, because I'm very conscious that I'm in between you and lunch. Although I now think we might go on to a party, because, I think Michelle said it wasn't a party, but I think we're now back in party, because congratulations, Tish, and then also congratulations on 30 years Equity Release Council. So I have to ask Robert if he has something to celebrate, but maybe not.
Just being here.
Just being here. It's very good. So if I can open up with an easy question. Robert, do you have any reflections when you saw that whole timeline and the equity release market and the standards, regulations, etc., the history, where it's now, and perhaps also give us a little insight of what you think 2022 might head into?
I think it's an interesting point to look at, in that anybody you ask about regulation in the UK, they would probably say that we have got the most aggressive regulator of anywhere in the world, in terms of the rules they write, the controls they put over our industry. Yet, in spite of that, we have a situation where an industry feels it has to put a set of more standards on top of that in order to make its consumers feel safe. And you have to stop and unpick that a little bit, particularly when you get to the discussions about vulnerability. So clearly this is an industry which has felt for a long time that, given what it's doing to people in terms of the offerings it provides and the way that it works, it has to go above and beyond even the most aggressive regulator in the world. And that's an interesting conundrum that we have to unpick in terms of the responsibility it then gives to everybody in this room, whether it's product manufacturer, advisor, or all of the infrastructure that supports that, whether it's in the solicitor arena or the surveying arena. And that's really critical for me. Now, the important thing is that the industry has self-identified and is self-policing. And it's really positive in my view. So I'll put the negative out there. The positive is that it has identified that, but thinks about it. But it does put a huge onus of responsibility, therefore, on people, because what you're effectively doing is gold-plating everything and creating an incredibly high standard for yourself that you then have to live to. You have to live it and work it and adhere to it. And there are many people in the room here, and in fact all the people in this room probably are really, really good at it. The problem is, there are people doing this job who are not in this room, who are actually, and I'm going to use the word, they're shit at it. And I recognise this across the whole piece. In conventional residential mortgages, with people who are really good at selling mortgages, they're totally crap at selling protection. In this world, we will still have a shade of people who are really, really good, who do great jobs, really look after the customer, and really do it well. At the other end, we will still have people who actually shouldn't be in this sector, in this industry at all. And we have to find a way of dealing with that. And one of the big things in the discussions we're having with the regulator about the cost of PI and the cost of the compensation scheme is that residential mortgages, and Esther was at the front of a lot of this, rinsed out about 2,000 bad advisors between 2012 and 2014. We've not seen that in any other aspect of the sector, of the industry anywhere, whether it's pensions, investments, anywhere else. We've not been great at self-policing. And we have to think about our responsibilities because, as you've indicated, consumer duty is coming in a way that will make a fundamental difference to our industry. So I think all the numbers say great opportunity. The funding's there, the demand is undoubtedly there because consumers need this product. I've been standing on stages since 2009 with Dean Murphin saying this will be a £20 billion market. I still believe that, but we have to make sure we do it responsibly. And we'll come to other stuff later, but that's my kind of view of 21 into 22. Great opportunity, but God, be responsible.
We do. I agree. I think it's always the lowest common denominator in an industry that sort of sets public perception. And as Alison said, there is the demand, there is the supply. We need to make sure that engagement works. So that's a really key point. Tish, do you have a view?
First of all, I had lots of messages this morning wishing me happy birthday and suggesting ways I might like to enjoy it. But none of them suggested I might like to have a debate about later life lending and its future. So they were all wrong. So it's a great way to spend my birthday, so thank you. What my thoughts about the slide that you put up there about the timeline is actually quite shocking in a way because it said it was 2004 that the lifetime mortgage was regulated. And that was when the Financial Conduct Authority asked myself and my joint chair at Solar, Jane Finnerty, to come in and draft those standards and write those standards 2004. I seem to have blinked and we've moved on. What my reflection on that is, when we wrote those standards, we were writing for the market we had at the time. And I've seen those standards evolve, but what I would say is this. I've been privileged, and I really mean that, because obviously I'm not a financial advisor, to be a part of watching this financial services sector grow a lot since then. And I see a massive, massive change in the equity release, later life lending sector. I mean, I don't need to say it, you've heard it all here today. The different products, the innovation, the standards, the work of the council. A concern I would have, and it's not a negative, it's if you don't address concerns, you can't improve them, is that I did some random research. Obviously, that's my excuse for using Facebook. When my husband says, what are you doing? I go, I'm doing some market research. But what I did was, I looked on some of the adverts that people put on there where they advertise equity release. And it is still shocking that you will then get hundreds of comments around, let's just say that they don't give a very negative, positive attitude. And that is worrying because, obviously you don't engage on social media with asking them anything, but the scandal, as it was, that was equity release was in the 1980s. A lot of people here weren't even advising then, or even perhaps even born. And so what it tells you and reminds you is that the consumer has a long memory. And, there was a mention earlier on that there is a curiosity, like how many people have been looking. I absolutely think there is. One of the things is that the pandemic has given people more time to sit and reflect a bit. What they have got is a curiosity with caution. And that's because there is this historic negativity. And when you look around at what you're all doing, it so shouldn't be there. So my thoughts for the future are really around how we move that. And it's my entire reason for founding Solar, as I did years ago when, as I say, I'm not a financial advisor, was because I saw firsthand how brilliant they were, as some advisors were, and I felt as a consumer, how do I find you? And it is all about consumer confidence, And so one of the things Solar have done, and we're looking in terms of helping to move the market, what can we do? We've gradually built our reputation, small but perfectly formed, as a we are a consumer organisation. We're not a financial services organisation, and we're all about consumer confidence and getting it right for the consumer. So one of the things we have done is we've launched, and it was referenced earlier today, a later life lending advice standard. And if any of you want to look at that, you can simply look it up on Solar Later Life Lending Advice. It's going really well, but it's a way in which we want to try and bridge the gap that is there, and we're going to talk about it later today, so, better people than me can speak about that. But the regulatory regime, as it is, the consumer can't wait for those changes. They want them, they need them. But right now, how does a consumer find people that can help them with later life lending? They're not interested in the silos. They don't know anything about it. Everyone here knows that when a client comes to see them, it's the same with me as a barrister. When people come to see you, what they want is you to solve their problem. They're uniquely uninterested in why you're limited in what the advice you can give, or why later on you didn't think of that option. You mentioned in tax planning, my background as a lawyer is inheritance tax planning. I can guarantee you, and I've been chairman of STEP in my county for a long while, that you would not think about equity release as an inheritance tax product. Why? It doesn't come up. It's a silo, isn't it? And a silo that shouldn't be there. So I must stop now. It's my bandwagon. But I do say, listening to ending the silos in the regulatory will help no end.
And thank you, Tish. And that neatly brings me on to, before we plough into, is the regulatory framework and the guidance fit for the future and the growth that we've seen, the very specific question, I think that was mentioned several times today. I think Callum did it this morning about, the holistic advice versus lifetime residential, etc. And I know there are some perhaps challenging opinions on the panel, so I'm looking forward to that. So, Robert, do you want to give us your view? Should the regulator change, and should we get holistic advice for all customers all the time? Or give us your opinion, please.
Okay. Let's start by, history is quite important in this. We start from a premise, which was a debate that was held as part of the mortgage market review, that said that Adair Turner was absolutely clear as the chair of the FCA, and Linda Blackwell supported him as the person who was responsible for the mortgage market rewriting of MCOB, that the fundamental principle that was baked into that was, one, everybody should repay their mortgage before they reach the age of stopping work. And that was baked in as a principle. And interest only was bad. They baked those in. Now, that means that in order to rewrite anything that sits around that mortgage conduct of business book, we have to challenge that fundamental premise. Because actually, what we teach people is, must pay off your mortgage, have another mortgage. It's crazy. It is crazy when you think about it. Now, the other element of this is, can firms do holistic financial planning today? To which the answer is, yes, you can. Because you can, as a firm, carry all the permissions, as many do, and put the right people in the room to give that holistic advice by doing that activity. So it is not prevented by regulation. The other element is, do you want to do it? And does the regulator recognise that if you want to limit your scope of advice to protect yourself and allow yourself to not carry too much capital, have PI that looks prohibitive, and actually deal with customer segments that work for you and you can commercially deliver at the price that the customer is prepared to pay, then you should be allowed to restrict your advice. Now, if we break that model and says everybody must do everything, you have to take the consequence of that, which is if you only want to be that advisor, you can only do it by partnering with other people to have that holistic advice, or we accept the model we have today that says you can just do mortgages, you can just do mortgages in real, you can just do mortgages, real and equity release, and ignore the asset side of the balance sheet. Now, there's a third element to this that gets really complicated. That is, in the world we operate in today, in most other jurisdictions, financial planning is not a regulated entity. It's not in the UK either. Writing financial plans, i.e. sitting on a customer and saying, you need to invest X into this type of product, i.e. you need to put £500 a month to your pension, you can afford a mortgage of £1,000 a month, is financial planning. It's not regulated. Only becomes regulated when you begin to tell the customer which company and which product to put that money in or borrow from. The risk people and the compliance people in our industry have stopped us doing any of that because they are shit scared of people crossing the boundaries. And we've built this infrastructure for the 25 years where we're all scared of our own shadows. And that's the problem we have to unpick, Because when you go to talk to the regulator about this, the philosophy of this, and Treasury about the philosophy, they go, Robert, you're talking nonsense. Because this is not a problem of our creation. It's your creation, and you have all the solutions in your own hands. It's what I would say.
Thank you, Robert. That's very interesting perspective and a good view, is it does. And if you have any questions, by the way, note them down. I'll come to the public later. Dave, do you want to give your view on that?
Yeah, I mean, in many ways, I agree with Rob. It's official, breaking news. No,
yeah, I was about to say that.
But so we agree on the history. I mean, I think the history is also, we've got to look at it from the perspective of the customer's history, of their attitude to wealth. And there needs to be a continued shift in attitude to look more holistically from all their assets at their disposal. And that's unfortunate. That's obviously being governed by the way pensions have gone and the like. So it's inevitable, but we need to be able to do more, and there need to be levers, not least the way, and we've been involved in this, the way the pension dashboard affect things, and the way there's a more holistic understanding of assets, so that the customer is able at an earlier stage to plan better rather than having to just make decisions that, and certainly not in the last resort decisions. So we're all in favour of early planning in that sense, and I think there's more that we can involve ourselves as an industry to help support that customer awareness and attitudinal shift. So that's something we can all agree on as well. I think where, from our industry point of view, is that there's issues that we can also look at, things like the exams, about how that, not saying that everyone should get in this whole holistic world level 4, but certainly there needs to be a better understanding, a broader understanding, and probably a more rigorous understanding of everything that is at the disposal now of an informed customer. So that needs to be reformed. And there is some work, I think, in previous panels involved with Rob and others, about there's movement on that. And I think we've just got to get better in this technological age at how we probably recognise there's always a role for specialisms, but that we do ensure that as a service, that we provide a greater referral and understanding and way of working together. So we've got to keep going, and obviously that there's not just ourselves involved, as it's not just financial advisors. There's also obviously a wider issue for lawyers, for others in this whole market, and wealth managers who are involved as well. So we need to respect our difference, but try and work out a way of providing the customer with a better journey.
Mm-hmm. And Tish, do you want to?
There's so much agreement that the strategic plan that I should sit in between these two is completely unnecessary. So that's a positive. Yes, I'm leaning slightly more towards here what David said, in that I do agree about specialisms, but these things are so interrelated. But one of the reasons why equity release, I heard it mentioned earlier about, people using them, the things they can use them for. One of the worst things that people have done, and the press have done it as well, is to talk about it as a matter of last resort. Now, that is such the very worst thing you can do. And the general consensus here seems to be that, and I would support that the best way forward with later life lending would be if it does become much more part of an integrated later life advice, which is obviously what we do at Solar. And it was a few years ago now I founded Solar, we insisted that people did have the equity release exam as part of before they could have accreditation, even if they didn't have the mortgage permissions to transact the business, because we needed them to give later life advice, and people don't know what they don't know. And I think that is the big issue for talking about making it more general. So, for example, the mention that Robert gave, and I completely agree with you, is there's a possibility to hand over to specialists, isn't there, to say, we do this and we hand that over to specialists. But that's really where the consumer has come to the advisor and said, this is what I want to do. The other side of the coin is where the consumer is there, the customer is there, and if you only know your silo, you will never be able to pick up the other options that might be available to them. So I think, on balance, I'd be much more in favour of it being a wider, non-siloed activity. Mm-hmm. The only thing I would say, and it's very, this is just my point of view, I'm quite small, so you probably missed me if you threw something. I mentioned at the end of, I'm not saying that everyone should get level 4. I'll just throw it out to you. Why not? Why not?
In its present form?
No, I think there should be changes
Yeah,
that,
that's what
but
I
I
mean.
do
Yeah,
believe
yeah.
that you should be level 4. You know, it's inconsistent for the FCA to talk about vulnerability and to really highlight that. For you all to sit here today and talk about the vulnerable clients, it's inconsistent as well for you all to obviously be able and perfectly able in terms of being able to pass the exams to have that level. If you want to be professionals, raise your standards. I would love to have been a barrister and only just given them my GCSE results, but they wouldn't take that. So, you know, I would say raise your game. You're all well able to. Go for something where, when you get to holistic, as you say, it's not something you say, oh, you don't know what you're talking about. The standard is higher. Take a look at our later life lending advice standard as well. And on that, in there, there is the vulnerability option, which I know a few of you are aware of. So far, more than 10,000 advisors have taken this. Solar wrote it, supported by Just. It's a free vulnerability training tool. So do have a look at that. It's very much geared, it's part of the equity of the later life lending advice standard, but freestanding.
Thank you. And I'm really pleased to see that level of agreement amongst the panel members that actually we can get there, and it's taking the step forward in that broader engagement, education, raising the standards as an industry. So good, that's good news. Talking a bit about, you know, we heard a lot about today about growth, diversification of, you know, what people do, etc., etc. So do you think the current regulatory framework is fit for purpose, or do you think, you know, going forward there should actually be changes, and taking into account the context, Robert, you gave as well on, you know, as an industry we almost, have standards that go further than what the regulator does. So, I don't know, David, do you want to go first?
Yeah, I'll just pick up on what Robert said to make sure that we're not totally agreeing. But in terms of the issue of regulation, I think it's I say in jest. I think it's no one's going to be in favour of gold plating, at least for me. But just the issue is there's a role for gold standards. And those don't always have to be plated in straitjacketing people. And I think the approach actually is how you operate, how it operates, and to ensure that we've ourselves moved from this rules-based approach to one that's much more principle-based, outcomes-focused, to generate and encourage good practice. And the FCA would want to be in that place, but they don't have the capacity or function to move that way. Now, the Consumer Duty is seeking to go down that journey, but it raises a whole lot of questions. We haven't got the detail yet, and frankly, it's causing concern because people are wanting to work out exactly how we go. But the trajectory is good, and I think if the regulator is going to have if it's going to operate more in terms of a duty, as long as it provides sufficient detail and it doesn't, as I say, get so involved in retrospective approaches, and also that it gives sufficient timelines for people to be able to move forward, then I think it's in a better operational place to avoid everyone being straitjacketed and obviously subject to all the implications of that.
Robert, I can see the thoughts forming because, you know, I guess in that context also, as you said, we shouldn't be scared of our own shadow, so that with Consumer Duty, what might happen, but your perspective.
So Consumer Duty, which the current consultation closes on 20th of February, current plan from the regulators to issue the final rules in July for implementation by the end of next April. That gives us 9 months as a global industry to incur 2.4 billion of one-off costs in order to restructure how we do everything. Not quite sure how it can be done in that time frame, and that any major exercise like this before, whether it's TCF or others, has been phased over a much longer time frame. And even MMR, that was not as big as this in any shape or form, they gave us 2 years to get from start point to phased implementation to final implementation. So this is weird, and it's TCF on steroids is how I try to describe it, because what they're really saying to us, and this is why this sector has a really, really big issue in my view, in how we argue and deal with this, because I'm not saying I'm separate, I'm part of this argument and debate. How do they expect us to go back and really look at how we're going to manage a product which has a 25, 30, 40-year life cycle, Because the rules, as they're currently drafted, say that you have to have certainty that's appropriate for the customer for the life of the product at the time when you advise on it. At the moment, TCF is about it's appropriate at the time you advise, i.e. it's suitable then. This is saying you have to make a judgment it's appropriate for the whole life of the product, and that is hugely complex, particularly in a product where consumer circumstance can foreseeably change significantly during the life of that product in a way that is quite unpredictable, and that's what all the vulnerability stuff tells us. Now, how do we deal with that? I'm not sure, because we're going to have to ask for longer to think it through, I believe. Now, it also demands a greater partnership, because it also demands in there what they call fair value. Fair value assessments from the manufacturer and the distributor about the cost and allocation of the product. And I will say this out loud in this forum, because I will say this because when my good friend Esther pays 37 bips for a standard resi mortgage, and you've got proc fees running in your market for broadly something half the value, I'm struggling with fair value in that market where you've got the same manufacturers doing the same thing in the same structure. So we have to think about that really clearly, because the manufacturer is going to document fair value about what the costs of the product are and what they're paying out to distribution. Distributors have to clearly state what it is they're doing for that money. And that becomes complicated because it's part of this whole process. The other part then for me is the really complicated bit, which is when the customer has got these much more flexible products where things change, where they decide to stop paying the interest in servicing it and moving to roll up and or take additional money out, who is responsible for validating at that point that it's still appropriate? And if that's the case, is there a point where this becomes a product that's not just about upfront commission, but it's got trail attached to it with responsibilities that the broker picks up? These are huge debates that this industry is going to have to go through in the next... And the regulator said, don't wait for the rules, start thinking about this and doing it now.
Okay.
Which I never like, because you should not ever have to work until you've got final rules. It's just wrong from any regulatory perspective that I understand. I'm done now. Just
thank you.
That's enough.
Thank you. I think you've scared us enough again, by the way, Robert. Thank you. Something we need to work through as an industry. I think in the interest of time, we'll just open up to the floor to see if there are any questions that people have